Okay. Hey, everyone. I'm Tom Thornton of Hedge Fund Telemetry, and today I have the Hedge Fund Telemetry sector note analyst, Tracy Shuchart, I just, um, who covers energy and materials, and we're going to talk about the state of the energy markets right now. It's a precarious day. Fed Chairman Powell and Treasury Secretary Yellen are just puking on the market right now, but we have some really good stuff, and Tracy's going to go through what she's seeing, and I think it's, again, very timely. But first, our disclaimer. There is risk in trading markets. Hedge fund telemetry reports are based on information gathered from various sources and believed to be reliable, but are not guaranteed as to the accuracy and completeness. The information is subject to change without notice, and hedge fund telemetry has no obligation to provide any updates or changes. Hedge fund telemetry is providing this data for informational and educational purposes and does not believe that it is sufficient to base an investment decision on. The information should not be regarded as a solicitation or recommendation of any particular security or to engage in any trading strategy. One should always check with your licensed financial advisor to determine suitability of any investments. So here we have this beautiful rig. Tracy, where is this rig from?
So I think that is in the North Sea.
Oh, it's gorgeous. Okay, so today, Tracy, why don't you give us the overview of what we're going to talk about?
Sure. So we're kind of going to talk about, what is the state of the oil market right now? Why is oil falling? Get into a little bit of seasonality, break-evens, yields, volatility. We're going to talk about OPEC a little bit. We have this meeting coming up, but we're going to kind of go into a little bit of the state of the OPEC markets. Then I want to go into inventories. Global inventories, US inventories, OECD inventories, a little bit about inflation, and then into our Capex problems and Capex needed, and then finish with my current long ideas or positions.
Okay, cool. So just for those that are not subscribers of Hedge Fund Telemetry, we are building out a sector note product, and Tracy is the first one with us covering energy and materials. And Tracy puts out several notes a week that are very, very comprehensive. They cover so much, and her main note comes out on Sunday. Tracy, just tell us a little about what's on the note and how to get the most out of those notes.
So generally I start with, it's generally a pretty hefty, long note, 50 pages or so. So I generally start with, what is the big news of the markets that week? What's happening. I kind of go into analysis of that. Then I have charts of the week. Then I have technical analysis, and then I kind of go into what is driving each particular market. So there's usually a section on oil and products, a section on nat gas, then go into some materials, which could be, base metals, industrial metals, kind of precious metals, depending on really what is kind of happening that week. I also, all fossil fuels. So coal is included in that. And then it kind of rounds out with oil inventory updates on the week globally.
What I really will say is I've been in the markets a long time, and I read your notes, and yes, they're super comprehensive. They are super detailed, and I pick up something new all the time. And I've actually improved my knowledge of the energy sector reading your notes of how the inventories and the supply and demand and all the cast of characters from OPEC to Russia to, all over, how they integrate. And it's been quite a year for energy. You've been super right on it. You've been bullish the whole time. And I think that I've seen your presentation. I think it's going to be really informative here. But for everyone, we have a special limited time offer for Tracy's energy and materials sector notes. The annual rate is normally $1,000 per year. And we're doing a very short limited time rate of $500 for the first year. Your first year goes up to 1,000 the next year, and you'll find it worth it. If you use the discount code Tracy during checkout, and you'll get that applied. And it's only available for the annual memberships for energy and materials sector notes, not the quarterly, which would basically be free. But we're building out this with Tracy. I'm super proud of all the work she's done. And so why don't I do this and let myself turn it over to her, and let's go through seasonality.
All right. So, well, in general, so why are we seeing oil prices falling besides the obvious, Omicron fears right now? So we go kind of into seasonality. I mean, really right now is the weakest time of year for oil prices. And generally, about mid-December, we start to see a bounce again. I know that every year is different. I was saying this year could be kind of different, but, something just always seems to happen and the markets follow seasonality. So that's that. You can go to the next.
I would agree. I think your seasonal trade from get long, super long in January and February, and then towards June, it starts where it seems to top out. But every year is different, and we've had just a crazy couple of years with COVID and all the other crazy stuff. So let's go through.
So what we've been seeing is basically, we've seen the curves change right now. So because of the flattening of the curve, so we're seeing length taken out of spec length taken out of the contract, which is interesting. We're still backwardated. What is interesting is that we're kind of seeing, and that's the yellow line is November, and the green line is October. So you can see how much the curve is flattened out, and that's kind of forcing people out of the markets. But what's interesting is we're seeing a pickup in the back end. So what usually that means is that funds are getting out of the front end, going into the back end. And then we also, also refiners are back there as well, hedging. So just interesting to see the curves change and to realize that when, the curve starts flattening, we start seeing length taken out of the front end.
Okay, break-evens and yields, how does that apply?
Right. So basically, we're having a reversal of inflation break-evens, which again is forcing people to take inflation hedges off, right? And so oil, gold, typically gold and oil are inflation hedges, but gold is kind of broken right now. So we've seen people really use oil as an inflation hedge. And, as those break evens have started to reverse, again, it's forcing people to take some of those inflation hedges off, which means length out of the front contract as well. We're also seeing kind of a pullback in yields, again, forcing people out of inflation hedges.
Now, crude oil volatility. I have two charts in here. You wanted to focus on this one, and then we have another one that I really wanted to put in just for context of just how crazy the last couple of years have been.
Yeah. Well, you can see, obviously, we're very high right now, 63. Really, you want to see this kind of pull back down below 40 to really start getting really bullish.
Okay,
That's
so
really
in context, we can all remember that day.
So there's your negative oil in April of 2020. You can see volatility went over 300. It was 350, I believe.
That was crazy. But look at the little move that we've had so far here, and that just goes into showing the context of.
Yeah, I mean, and it's still, oil volatility is still very high comparatively speaking, right? Even though it looks small on that on that particular chart. But really, if we go into, besides this big pullback that we've seen, really, if we kind of get into the fundamentals of the market, the physical market still looks absolutely fantastic, even though we've had this giant pullback in the front end. So if we kind of look at kind of where OPEC, we'll start with OPEC is, and really the OPEC plus capacity overhang is not really what people think it is. I mean, real spare capacity is about 43% below market expectations. The banks kind of got a whiff of this. I have to give Bison credit. They actually pointed this out much earlier than the rest of the banks. But so really spare capacity isn't what we think it is. And that's another reason why when Biden is calling OPEC and saying, please pump more oil, really, they don't have the capacity to do that. Then we can go
and that's on this one right here, correct?
So, well, it's on that, not go back one. It's on the bottom left-hand corner. Bottom left-hand corner of this chart. That was just the next chart's just an emphasis of that, but let's finish with this slide. So if we look at the bottom right-hand corner, basically OPEC's been missing their quotas pretty consistently, right? So, secondary sources have said it's almost as much as 595 barrels per day, but it's generally been about 250,000 barrels per day. So they're not, it's a different OPEC than we are used to seeing. When we used to be able to see everybody was cheating, everybody was pumping more oil than they said they would. They actually can't, and they've actually been coming in consistently under quota. If you look at the top left, so we still have major shortfall target for capacity growth. It's almost 3 million barrels per day out to 2024 than they originally had said. And that's due to delayed capital investment plans due to OPEC or due to COVID-19, increasingly complex fluids and geology and new reservoirs. We have natural declines in core assets, declining infrastructure quality and reliability due to underinvestment, suboptimal policy developments, and political instability. Or really what OPEC is facing right now and why their spare capacity is not as high. And we have increasing risk to smaller producers such as Nigeria, Libya, Algeria, Angola, where they're really struggling to maintain consistent output at even their quotas. And even though they're much smaller producers, you have to realize that, a lot of those add up. And then really, OPEC, the fiscal break even's about 775. That's not production break even, that's fiscal break even. So OPEC's benefiting already from, sustained higher market share and higher prices. So I don't really think they're going to, I don't really think they wish to ruin this balance, nor do I think that they really can. And if you go to the next,
Now, one thing, so we have OPEC tomorrow and Thursday.
Yeah, tomorrow and Thursday.
Do you expect anything surprising to come out of it?
I think,
and I'll move to the next slide.
I think that, and that's just another, that's just to highlight the spare capacity problem again. I think that's, I would be surprised. They have three options. Let's put it this way. They have three options: keep everything as is and add 400K barrels per day for December as planned. 2, decide not to add that capacity. And 3, they could actually pull back in production some. So they could possibly take off the 400K that they added in November. I think that more than likely, they may not go ahead with the increased production, being that there's so much unsureness in the market right now over this new Omicron variant, and we're starting to see countries in Europe lock down. We've seen a lot of flight cancellations. And so I think they're going to be, again, very cautious because, it is to their benefit to keep sustained higher, to keep oil prices higher. It's better for them. And their job, really, their stated job is to smooth out the markets and stop this volatility. And there's just too much volatility in the market right now. So they're going to have to do something to kind of quell this market a little bit.
Okay. Do you want me to move on to Russia, or you want to talk
Yeah,
about
we can
this
go.
chart?
Yeah, and I just threw in Russia. Yeah, we can move on to Russia. I just threw in Russia because it's very interesting. I think they're going to be the last man standing. They're going to pump until they can. But what's interesting is because they're not really, they don't really care about ESG and whatnot. And their focus is really on oil. But what's really interesting is we really start to see a decline between 2025 and 2030 in, what they can even produce, being that they have, older fields as well, and not much new Capex either. So likely, between 12.5 and 13.5 million barrels is probably where they're likely to top out at. So just interesting fact on Russia. On global floating storage, right? We just had a big pullback this week of 17% draw globally, which was very nice. We've literally worked off all the overhang from 2020, although we still are above, 2017, 18, 19 levels. We are below 2016, which is, you can barely see it on this chart, but we're still below 2016 and prior levels. So we're very low, and we seem to keep drawing, which is a positive for obviously the oil markets. And then we can go to US crude inventory. As you can see, of the big four, crude, gasoline, distillates, and jet fuel, I mean, we're at 2021. Our stocks are at the lows as well. I would also add that even our SPR is at the lows as well.
And I have a question on that because it's in the news, obviously. What was that, 50 million barrels? Will that really make a dent? I mean, I'm sure that the administration is going to take great pride in saying that they lowered energy prices in the last week, but is that SPR release, is that material?
It's not really that huge, and let me explain why. First, 18 million barrels of that was already scheduled release. They're just upping the schedule, so that was already pre-planned. So it's really 32 million barrels, which is, considering the U.S. consumes 20 million barrels a day, it's a day and a half, and it's a day and a half of OPEC production. And even with the coordinated release, it is 50.83, which is, sorry, let me go back, which is a day and a half of OPEC production. With just the 32 million, it is a day and a half of the United States usage. So in the bigger picture, and it's spread out over months. So in the bigger picture, it's not really that big of a deal. Then we have OECD inventories. You can see, we're well below normal levels. Again, 2020, the overhang has been drained, and we're still looking really good, and as far as that's concerned. And I'm just kind of showing these inventories to show you that fundamentally the market is strong. There's not crude gushing everywhere, right? We're drawing down onshore and offshore stocks significantly. And then rig counts, normally I don't care much about rig counts. If you've been following me for any length of time. However, given the sharp decline that we experienced, especially in 2020, it's interesting to note that even though oil prices have moved higher, a lot higher, rig counts haven't really caught up with that. So, we're still seeing some discipline in the market. Not everybody's, all of a sudden pulling out all the rigs and we're producing like crazy. And then again, another worry for the market is this is drilled but uncompleted wells, right? Look at that stock drawdown that we have had. I mean, we're chewing through DUC inventories, and this also poses a problem for future production increases from the U.S. because usually we like to keep, a pretty stable inventory of DUCs, and we're chewing through them. If you look at global oil demand, again, and I would say that this is pretty conservative, but just to show you, global oil demand is still set to grow. But, we're already at, well, according to BP, we're already at over 100 million barrels per day for 2021. So that's ahead of schedule on this particular chart. We should see a lot more growth. We're going to see growth from Africa and from Asia is where we're going to see most of that growth. Inflation, I think inflation is here to stay. Obviously, Powell just said she's taking transitory out of the vocab.
We retired the word transitory, apparently.
So, I think inflation is here to stay. We still have the same problems that we still have, supply chain problems. Those are going to take a long time to get worked out. You can't just turn off the market and then turn it back on.
Explain what we're looking at here.
So this is sector performance during inflationary periods. And if you look, generally energy does extremely well during inflationary periods. And that's
I see the red
energy. Yeah.
Right. Okay.
And it was actually, and it's actually been lagging this year. So, I think that the market still has a lot of upside available to it in the sector, and not only in crude oil over the next couple of years, but also in energy equities. Here's our problem. Here's our major problem. Is that we have had declining Capex for 7 years, right? And so with oil demand set to grow and lack of Capex, we're gonna have a serious problem. And what we're seeing right now is oil companies are not focusing on Capex, right? They've got ESG concerns. They're trying to increase free cash flow, right? They're trying to pay down debts. They're going to try stock buybacks, and they want to give investors shareholder dividends. And they're all on the same page, and that's what they're all doing. So that means that we really are not going to see any kind of rapid growth as far as oil stocks are concerned. And then here's our overhang. This is what we need in order to fill that gap between supply and demand. We're gonna need we have a $750 billion Capex gap, which is huge, especially taking into account that nobody wants to spend money on oil wells anymore.
Very out of favor. And when you see all the just one question. When you see the current administration just blatantly saying that they want to put energy companies out of business and they want to move to alternative sources of energy, that seems like a very nice and positive thing that voters would like, but how is that impossible?
Well, it is impossible because unfortunately the technology one, the technology just isn't there for us to just switch over right away. So you can't switch off oil and not have the technology there to build out other alternative sources of energy. So the technology, so not only that, there's, you know, I just lost my train of thought. Sorry. Technology is not there. Right now we're depending on wind and solar. Those are intermittent resources. You can't have intermittent resources as your power base load. You're either going to need nat gas, oil, coal, or nuclear, something like that. That's just not an intermittent power source. And so you can't just switch over. You need to have something as your base load that's consistent, right? And so, we're still going to need a lot of fossil fuels. We're also going to need a lot of fossil fuels in order to make these energy transitions, right? There's a tremendous amount of fossil fuels and industrial metals and minerals that go into building wind turbines and building solar panels. So we're going to be increasingly needing more fossil fuels to build these things, and more mining, quite frankly. And mining is also energy intensive. So, this transition is going to take a lot more fossil fuels than people realize that it will take, and it will take a lot longer to be able to transition.
One question I get a lot is on uranium and the whole nuclear power thought. And you can see it in Europe, and you can see it in China as well, where the nuclear power industry is alive and well, and they've been able to bypass, well, I'm not really China, but in Europe, bypass the quote risks of nuclear power, and they've really made that put that on the forefront. Do you see that happening within the U.S. anytime soon? Because I know there's rumblings of it. I know there's a lot of people and some politicians that are talking about it, but of course it's the not in my backyard problem.
Yeah, I mean, there are starting to be rumblings. I mean, and we've had, nuclear is big in, say, France. Germany was pulling back from nuclear. Now it looks like, they're starting to talk about it again. So I think you're going to, and we're starting to talk about it here again, because I think people are starting to realize that, wind and solar, we need more than just wind and solar and hydrogen. And it's a solid base load. So I think, the uranium trade's a very difficult trade. Yeah, as you know, I've been long over the years a couple times. It's a very difficult trade. Although I see, in the future, I think it's definitely worth looking into now that we're seeing sort of more talk about it from the West.
Yeah, I think if the ESG folks really started to pick up on actually how clean nuclear power is versus, they look back at, oh God, Chernobyl or 3 Mile Island and all the other problems that happened. That's like looking at a computer in 1970 versus a computer in today's world. I mean, we have more power on our phones than we did at a nuclear power plant in the 70s.
And, and a lot of the complaint was the radioactive wastewater, right? That's what the environmentalists are against. But, I think that there's, new technologies involved. It's a lot, cleaner or safer than it was, 30, 40, 50 years ago, obviously.
Right. Okay. So here we want to talk about North American integrated.
So just to give you an example, so North American integrated sector has about a mid-60s Brent oil price break even in order to cover all capital spending. And I think one of the most important aspects of the analysis is the new energy Capex, which is still quite low at about 2 to 3% in total of 2022 to 2023. But if this spending wraps up, potentially 2 to 3x over the next few years, that could place break evens closer to $70 a barrel out to 2025. This sets us up for much higher prices into 2022 to 2025, which I think could be a boon for mid-sized E&P companies, oil services, and mid-tier integrated.
So this leads me to your long ideas, and why don't you just go through some of these names and why you like them?
So DBM, because it's a mid-tier producer. Same with MRO. I like MPC, which is a refiner. They are getting into renewable diesel. I think there's a lot of opportunity in that space. They're even changing over some of their refineries in California. AR is Ontario Resources. That's a pure NGL play for me right now. We have propane inventories 13% below the 5-year average. They're one of the top 5 NGL producers. Heading into winter, I think it's a strong play there, because if we had an accident, say like we did in Texas last year, where the grid went down and propane is used as an interim fuel, we're going to be in a little bit of a tight spot. CVE is my Canadian oil pick. SSL is Sasol, which is chemical companies. I think, chemicals, especially with this new infrastructure package, we're going to need a lot of chemicals, and it's a growth industry. It's a huge industry. And if you look at any kind of projections as far as chemicals are concerned, and I'll put this in my next report, then I think chemical companies are a good bet for the long term. And
okay. Go on.
Oh, and then PBR is my
Sorry.
PBR is my Brazil pick, because I think that's I think we'll be starting to see soon hopefully some recovery in South America. So that's my South American pick.
Okay, so that actually concludes the presentation, but we have a little time for some questions, and I do have several, and I just want you to do the speed round type of answers here. So Bob says, or he asks, do you expect the major oils, will they increase Capex allocation once they're confident of this growth?
As far as the majors are concerned, I'm kind of shying away from the majors right now, because I think they're too spread out into ESG, and their focus is there. So I don't think they'll be spending much money on oil, and their focus is everywhere right now, right? So if I want a pure oil play, I think your mid-tier is really where you want to be looking.
Okay, now, do you have any views on SAF, the sustainable aviation fuel, and price levels the administration might be targeting to make the tech competitive?
I do not have, somebody asked me that on another webinar, and I really haven't looked into it, to be honest, that much. Because, as far as jet fuel is concerned right now, that's pretty much low on the totem pole, right? And so, and especially with all these new flights canceling and everything like that, we really need to start seeing that portion of the industry pick up, I think, before we really see huge transition there, because people don't want to pour a bunch of money into an industry that's not happening right now.
Okay, moving along. Do you have any view on Russian oil and gas, like Gazprom or Rosneft?
I am a big fan of Russian oil and gas, only because, again, they're going to be the last man standing. They're not really getting into ESG. They're pure oil and gas play. So, and I think that they'll, continue to outpace both the US and probably Saudi Arabia. So I am very bullish Russian oil and gas.
Okay, Permian plays, frackers, takeaway players in the pipe space.
Pipe space, I that's been another tough trade. If I had to pick, I would pick Energy Transfer for that.
A lot of people have asked about natural gas, LNG, American LNG exporters. 1 year view on natural gas. Yeah, let's start there.
Well, I really like natural gas. I've been a huge nat gas bull. I think companies like Cheniere LNG are a strong place because they have distribution as well as production. And I think that, it's going to be a huge transition fuel, right? In places like Africa and in Asia, we're going to see tremendous growth there. We even had Europe recently, they wanted to not include gas in their new green plan, and they backtracked on that, realizing that they do need nat gas. So I think there's huge growth potential in natural gas. And I'm bullish that over the long run.
Okay, E&P versus transports versus services.
I like, out of those, I like services and mid-tier E&Ps. I think services will be really important. I love Schlumberger right now too.
Thoughts on Suncor, Canadian Suncor?
Canadian Suncor. I don't have a thought on that right now.
Okay.
That's a wait and see for
I appreciate no thoughts. And don't have a thought. We don't need to dance on this, of course. What's going on with natural gas, the price drop off, especially headed into the winter? I think that's a good question.
Yeah, I mean, well, we're seeing, nat gas prices in Europe obviously are a lot higher. TTF, which is Dutch nat gas, is like 36 equivalent US right now, $36. So, there's, we're expecting a little bit warmer weather. The US produces a lot of nat gas. I don't think that it's necessarily done to the upside. I still really like it, especially considering, we're trading at a substantial discount to pretty much every JKM, TTF, and UK nat gas. So that makes exports very desirable, because even with the cost of transport, it's still a lot lower than any of those currently trading.
Okay, I like this question. Do you think the larger companies are more focused on ESG than the mid-tier firms just because of politics?
I think that has 90% to do with it. Yes.
Okay.
To be honest.
Coal stocks have exploded after they crashed last year. Where do you think coal stocks industry is headed? Where do you think it's going?
I think that, in the near term, I do like BTU. We are starting to use a little bit more coal. We kind of saw a pullback on their earnings because they forward sold into the markets and it wasn't really at an ideal price. But Appalachian coal is going like hotcakes right now. So I do still think that there are some upsides in the equities.
Okay, we're coming to a conclusion here, but I want to just grab a couple more. I like this question. Do you see what do you see with the relationship between OPEC and Russia in the following years? Is it going to be as tight, or is it going to fracture?
I think that we saw that major falling out right when COVID hit last year, right? And that's when we saw oil tank, because Russia and Saudi Arabia kind of got in a fight. I think that experience kind of sealed the deal for their relationship again, right? So ever since then, we've seen a much more cohesive group. We've seen them working much better together. And so I think for the future, I think that relationship is pretty solid. Okay.
And we're coming to, we have two questions. What natural gas ETF do you recommend, or do you have one that you recommend?
So UNG, I think it's what most people trade.
Right. Yeah, it's it's that futures based ETF that always is tricky over the
Yeah,
long
it's
term.
very, that one's very volatile. That's why I kind of prefer playing nat gas in a company per se, right?
I
I'd
see.
rather pick a natural gas company than necessarily having to deal with the futures market, which is, crazy.
Okay, the last question I'll answer because someone was asking how long is the promotion code Tracy at Hedge Fund Telemetry for energy sector notes. Your first year, take $500 off, and that code is available for 5 days. So we'll have it for 5 days. And again, that's the first year. The second year, you're going to be more than happy to pay for the full amount because you're going to get a lot and learn a lot and have some profitable trades. So with that, I would like to just say thank you, Tracy, for all the work you're doing for our firm. We are super excited. Your subscriber numbers have gone through the roof this year, and we have a new site, a lot on there, and a lot more to go. And so, Tracy, thank you so much. I hope you have a great day, and thank you everyone for joining us.
Thank you. Thank you, everyone.